Hello, fellow Rebel Capitals. Hope you're well. So today I wanted to discuss the fact, and it is undisputable, the stock market is in the largest bubble in history. Now, this doesn't mean that the stock market isn't going to go higher. Maybe it will, maybe it won't. But you have to look at this in terms of probabilities. And then what I also want to do in this video is tell you some of the things I'm investing in right now outside of the stock market, the S&P 500, where I have had even better returns than the S&P, because I see the mistake on social media a lot of people make. They say, well, if you're not in the stock market, then the only other alternative is you have to be in cash and you would have missed out on all these gains. Well, not so. Not so. And I'm going to be revealing exactly what I've been investing, or some of the things I've been investing in that have had way better returns, but the risk reward makes a lot more sense than the S&P 500. So first and foremost, let's look at where we are right now and why we can say definitively this is the largest stock market bubble in US history. Right here. Let's go to this, and I want to give credit to Charlie Biello. I'm probably mispronouncing that. Sorry, Charlie. Fantastic chart, great work. You guys can follow him on Twitter. You can see his handle here, which is his name. So right here, the S&P 500 is now trading at 3.15 times sales. Sales. So I know one of the arguments I hear all the time in the mainstream media that why this is nothing like the dot-com bubble, this is nothing like that, is because during the dot-com bubble, well, they didn't have any earnings. And now they have all this profit, they have all these earnings. Okay, great. Well, let's just compare apples to apples. Because even if assuming that there were no earnings whatsoever back during the dot-com bubble, then based on this metric, or no sales, no revenue, another way of saying that, assuming that there was no sales and it was just pets.com, and that's the only thing it was back during the late 1990s in that dot-com bubble, then you would expect to see the ratio of price to sales much higher back then, because the sales component of that was so low, right? But what we see is that's not the case. That right now, even when you compare the dot-com buzz, now you can see right here in, let me zoom in for you guys. There we go. So you can see that when we were really going through that crash, I wish this chart would go back to 99, but the bottom line is it's the highest valuation in history, and that would include the dot-com bust. So wherever we were, let's say we're at 2.5, maybe at 3, we're not at the level we are currently right now. So, and almost any metric you look at, the stock market is massively overvalued, massively overvalued. Now, again, does this mean that the stock market is going to crash? No, absolutely not. But it's very similar to having a 19 in blackjack. You all play blackjack. Raise your hand if you play blackjack. In fact, in the chat right now, say yes if you have played blackjack or you understand how the game of blackjack works. Let me see in the chat. How many of you know how blackjack works? Okay, yes, there we go. And you guys that are watching this after the fact, after the live stream, you can just think, I'm sure every single person understands how blackjack works. Now, the object of the game is to get 21, but not go over. Not go over, or you bust and you lose. So is it possible to get blackjack if you're sitting on 19? Well, then let's go back to this market watch. Is it possible to get blackjack if you're sitting on a 19, or if you're dealt a 19? The answer is yes, absolutely. You can get a 2. You can, for sure, that is totally within the realm of possibility. You can get a 2 and get blackjack. But would any of you, let's go back to the chat, Josh, would any of you actually hit on a 2? Tell me in the chat. Yes or no. Would you hit on a 2? Or excuse me, would you hit on a 19? So we've got no. No, no, never, no. So you guys get my point here. And why wouldn't you hit on a 19? Josh, let's go back to the Market Watch article. Because the odds are against you. It doesn't make any sense, even though it is an above zero possibility that you would get a better hand, that being 21. And it's the exact same thing looking at the stock market right now. Can you get 21? Sure. The stock market could go up from here. But what are the possibilities? What are the probabilities based on where it has been in the past? And the fact that usually with these PE ratios or price to sales or whatever it is, these things tend to mean revert. And let's look at Charlie's chart. Right now we're at 3.15, higher than we ever have been in human history, and versus the historic median, 1.6. 1.6. So I know the rebuttal I'm going to get from a lot of people here is, well, George, sure, the valuations, they're a little lofty right now. I'll give you that. There's no denying it. The proof's in the pudding. These are facts. These are charts. This is data. But I'm not going to time the market. I'm going to go ahead and just continue to buy the S&P 500, an index fund. I'm going to allocate 10% of my paycheck. And because at the end of the day, Dave Ramsey tells me that it's not about timing the market. It's only about time in the market. And I'm a long-term investor. That's right. So I'm just going to buy and hold. I'm just going to buy and hold on a dollar cost average. And I know, because I've been told by Dave Ramsey and every single other person on social media and in the mainstream media, that if I just buy and hold in dollar cost average, then this is the sure path to financial freedom. And this is the way that I'm going to be able to retire. This is the way that I'm guaranteed to have a 10, 12% annual return for infinity, for the rest of time, is if I just buy and hold. Because I've seen the charts, George. I've seen people do the math. Now, it is true and a bit odd that every single time I have a financial planner pitch me on this nonsense, they only look at charts going back to 1980. Why do you think that is, guys? Why do they only use charts going back to 1980? Maybe because they're cherry picking data. Now, it is true, believe it or not, that the stock market did exist prior to 1980. That's not when the stock market was created. So you, contrary to the charts that Dave Ramsey would show you. So what you can do is you can actually go back before 1980 and determine whether or not this buy and hold nonsense, whether this would hold up to scrutiny, to the data, to actual facts, as opposed to just opinions and cherry picking data. So when you do that, you see that, let's go over. We see the S&P 500 right here. This is adjusted for inflation, which is what you should adjust for, because at the end of the day, if you're investing in the stock market, the only thing you care about is not your nominal return, but an increase in purchasing power. That's why you're investing. That's why you're taking risk to begin with. So look at where we were 1930, let's say. We're at 461 on the S&P 500. Now, if you would have bought and hold for the next, call it, I don't know, 50 years, would you have increased your purchasing power? Answer, no. Look at where we were in 1980. We bottomed out here below 400 at 377. Again, this is inflation adjusted. Now, a lot of the rebuttal or the pushback on this is, well, you're not calculating dividends and blah, blah, blah. Okay, well, fine, but the S&P 500 really isn't paying you dividends right now. And they're not paying you dividends above and beyond the rate of inflation, the real rate of inflation, that's for sure. So I don't know, even if this doesn't include dividends in here, could we really include dividends here moving forward when the dividends are, you have to find them with a microscope? Effectively, you're not getting dividend. That's my point. So then when you look at this, you see that from 1930 to 2020, we have 9 decades. The stock market went up in 4 of those decades, adjusted for inflation. One of the decades, 1960s, were about flat. It was up slightly. And in 4 of the decades, you were down. You were down. Now, a decade, I think most people would consider that long. I'm a long-term investor. I'm not a trader. I'm going to buy today. I'm going to hold for the next 10 years, and that's how I'm going to retire. Well, you have been sold a bill of goods. You have been sold oceanfront property in Arizona. And the reason financial planners are telling you this is because they don't care about your financial future. They only care about collecting fees. And if you're not investing in the stock market, in the US stock market, then they're not collecting fees. If you're buying gold, as an example, well, guess what? Your financial planner isn't collecting those fees, are they? You see how this works? And you see the incentive structure? And you see why this BS narrative is just said over and over and over and over and over and over again, to the point where people don't even question it. And it's said ad nauseum because of the incentive structure. Because the financial industry, the people on social media, the people in the mainstream media, have a financial incentive to tell you that the stock market always goes up. It always goes up over time, when it's blatantly obvious that's not true. In fact, if your financial planner tells you this, just ask them to see a chart before 1980. Just ask them to see a chart from 1930 to 1980, adjusted for inflation. Just ask them to see a chart of 2000 to 2010. Ask them to see a chart of the 1970s, which, by the way, was the last inflationary decade we've had. And oh, by the way, the 2 inflationary decades we have had in the United States, the 1940s and the 1970s, had one thing in common. Well, 2 things in common. 1, inflation. Number 2 is the stock market went down when you adjust for the rate of inflation. So people like to think that, oh, well, man, we're going into an inflationary decade or an inflationary 5 years. I mean, the beginning of the 2000s, 20s was definitely inflationary. So this is going to be an inflationary decade, and stocks are an inflation hedge. Are they? Tell that to the 1940s. Tell that to the 1970s. Look at the 1970s right here. You've got 1970, we're at 646. And then you fast forward 10 years and we're at 420, let's say. And then a little bit further and we're down into the 300s. That's almost a 50% haircut. They call it a 35, 40% haircut in real terms. In the 1970s, in an inflationary decade where stocks were supposedly an inflation hedge. I mean, this is total nonsense. So now let's go ahead and look at the PE ratios today. Now, this is a different setup here. So this is price to earnings, I believe, the trailing 12 months. So this is a chart of the trailing 12-month S&P 500 PE ratio. So before we're looking at price to sales, now we're looking at price to earnings. Okay? So here we are not at an all-time high. So that's good. But look where we are. You're still at what, 28, 29? And compare where we were, the mean here. And what's the average? Let's just say 18, 19? So this tells you that if you're a buy and hold investor, long-term investor, because I'm doing the smart thing, that the odds of you having more purchasing power in 10 years from today, if you're buying now, is incredibly low. Now, is it zero? Absolutely not. The stock market could quadruple. Just like you could get a 2 if you hit on a 19. But no one in their right mind would do that. But yet everyone thinks that it's the smart thing to do to go ahead and buy the S&P 500 right now with 10% of their paycheck. This is insanity. This is absolute insanity. So now what I want to do here is, and by the way, if you look at the 4 decades where the stock market actually went up in real terms, so that would be the 1950s. That would be, well, first of all, let's look. 1950s. Where do the PE ratios start off? Oh, that would be 6. 6. We're at 29 today. All right. Now let's look at the 1980s. Where did that decade start off as far as PE ratios? That would be 7. Okay. As a reminder, we're at 28, 29 today. All righty then. Now let's go over to 1990s. Where do we start there? That would be 15. Okay. A long way from 28. And then let's go to the 2010s, which is your other decade where stocks went up. And we are at, I can't call it 18. We're still under 20. So the punchline there is we have never had a decade where stocks actually went up, adjusted for inflation, that started with PE ratios over 20. So then the next question becomes, okay, well, where were they in 2020 when we started this decade? And right here. That would be 27. Almost exactly where they are today. Nosebleed levels. Nosebleed levels. So based on this information, and this is not my opinion. This is facts. This is data. This is charts. You tell me if it's smart to buy the S&P 500 right now and just buy and hold, or buy the dip, or dollar cost average. I mean, it's laughable. It's laughable. But this is the nonsense that you're sold on social media, the mainstream media, and guys like Dave Ramsey. So now, going back to what I said at the beginning, people will say, well, George, I don't have a choice. I have to be invested in the stock market because I can't be in cash, because we know that cash is going to lose purchasing power because of inflation. So I don't have a choice. And this is how people rationalize it, as if your only 2 choices are just the S&P 500 or cash. That's it. I mean, that's laughable. Fortunately, we've got a couple other assets out there that you can invest in other than just the S&P 500 or cash. Let me show you what I'm talking about. First and foremost, I mean, this has been on, hopefully, everyone's radar, and that's gold and the gold miners. I mean, this is just year to date with the GDXJ, up 110%. 110%. What is this? What is the S&P 500 up year to date? Let me go ahead and pull up a chart. Okay, year to date, we are up, 12%. So let's do a little quiz. Josh, you want to play?
Let's play.
All right. Which would you rather have? A 12% return with massive downside risk, or would you rather have a 110% return with less downside risk?
I don't know. That's a tough one. I might have to phone a friend.
Okay. Well, Josh is stumped. Josh is totally befuddled. Maybe you guys can help him out in the chat or help him out in the comments. For me personally, I would rather have the 110% return. Now, am I in cash? No, no. We've got tons of different options out there. Another one that's totally off the radar, and one that we've been talking about a lot in Rebel Capitalist Pro, along with the GDXJ, by the way, is something I did not have on my bingo card. But fortunately, Chris McIntosh, who is one of the pros in Rebel Capitalist Pro, he's been talking about this a lot, and he's been heavily invested and had huge returns in this, the Greek stock market. That's right, the Greek stock market. So let's look at the index here, where we start off 2025 right around, I'm kind of eyeballing it here, guys, call it 1500. And now we are at 2058, if this is real-time data, just assuming that it is. But that's an increase of, let's just call it 500. So what are we there, Josh? An increase of maybe, or here we go. Geez, George. I guess that would be a little bit easier if I just go right here. So for the year, and this might go back 12 months, so I'll have to look at the S&P 500 to get an apples to apples. But for the year, actually, I think this might be for, yeah, this actually might be the trailing, or excuse me, year to date. But even if it's not, let's do another look at the S&P 500 so we can make sure that we're comparing apples to apples. This is up 44%. 44%. Okay, where the S&P 500 is up year to date. No, that's not it. Year to date, we've got 12%. And then over the last year, we've got 17%. And the Greek stock market, I can assure you, was not trading at a 29 PE or was not trading at 3.3 times sales. All right. So risk reward, much better there. So here's another one that I've been talking about. I've added to my portfolio more recently. We've been talking about in Rebel Capitalist Pro as a really good asymmetric bet, and that's uranium. Now, what I've done is I didn't buy, I had the Sprott Uranium Trust, but I sold that and bought URA. And we can see that URA year to date is up 63%. So again, looking at the S&P 500 up 12% with massive downside risk when you're buying in a huge bubble, as opposed to buying something cheap that has a pretty good catalyst, and your return is even better, your absolute return, but your downside risk is a fraction of what it is in the S&P 500, because this is not my opinion. There is no disputing on many metrics, such as price to sales. This is the largest asset. This is the largest stock market bubble that we have seen in U.S. history. So now if you want more information on Rebel Capitalist Pro, the things that we talk about there, these asymmetric bets, where instead of hitting on a 19, what we're doing is the complete opposite of that. Instead of betting where the odds are against us, we're making bets like uranium, the Greek stock market by the GDXJ, where the odds are actually in our favor. If you want more info on that, Josh, just go ahead and do me a favor and put a link in the description or put a link in the chat or something like that. And this is the investment community, the private investment community I have with my good friends Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Ceresna, and Jason Hartman. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.